We have our market master today, Gautam Duggad, Head of Research, Institutional Equities at MOFSL Financial Services. Gautam, great to have you with us here on the program. Prashant here. So I saw your report and I liked the front page, the picture. All Trump and his top officials sitting on a tree branch, cutting the branch while they're on the branch. So it's like self-inflicted, right? Drives home the message pretty clearly. But what is, that's a fourth quarter earnings preview. I think as we start to talk to companies, it's backward looking, right? Q4 in that sense that everything is happening forward looking now, especially with tariffs and what can happen. How are you thinking about this, Gautam? Because you write that massive uncertainty. If there's a full-blown war, not many sectors will escape, but there are also some opportunities in some sectors that can play out. Go on.
Hi, Prashant. Good morning. Thanks for having me. Yes, earnings will be slightly less relevant this quarter because people will be looking more at cues for numbers ahead and how the corporates in different sectors are dealing with the situation which is unfolding right before us in the last 4-5 days. It's very hazardous to make any guess as to how these things will evolve. Suffice to say that even the corporates right now, whomsoever we've been able to speak with in the last 4-5 days, they're also grappling with this situation, trying to assess the damage and what kind of changes they need to make in their supply chain, in their pricing. One thing which is very certain right now is that the uncertainty is going to remain for quite a period of time. And therefore, it will have a serious bearing on multiple things, which is the growth, second, the visibility of the corporate earnings itself, and third, as a consequence, therefore, the impact it can have on the equity risk premiums. Typically, you would have seen in episodes of such global uncertainties, which is basically not natural, but man-made, then the equity risk premium takes a knock. And that is where I think we've not been used to in the last 4-5 years. The post-COVID world has been very benign in the sense that liquidity was ample. The governments across the world were pumping in money, lifting the growth rates. India itself has seen a massive corporate earnings cycle post-2020, and that also lifted the valuation multiple across the indices. So everything was coming together. And of course, all of this was contextualized by a very benign macro and a very robust balance sheet across the corporate world. Now, one by one, a lot of these things have started unraveling. FY25 give us a hint of some bit of a corporate earnings slowdown. The reasons can be anything because the government spending slowed down and then you had a big urban consumption slowdown. CapEx started coming off. And now to add to that, you are seeing a new global headwind, which is just about, by the way, started. So very difficult to take a view at this stage. The approach, in our view, should be to limit the damage to the portfolio as much as you can and hope that the situation solves itself over the next couple of weeks or months. That's how we are placed right now. Amidst all of this, one silver lining is that a lot of the macros have started shifting in India's favor. So dollar index, which was 111 in Jan, is now 103. Crude prices, obviously, everyone is aware. They've gone off. Your 10-year yields are quite benign right now. And large cap valuations have corrected a whole lot. So the backdrop for long-term returns, the foundation is being laid with the caveat that it's very difficult to predict what is going to happen in the next 3-6 months.
Yeah, no, absolutely, Gautam, take that point entirely. But I want to sort of narrow this down to what we can tabulate and discuss in terms of numbers, and that is the earnings trajectory, right? We don't know what's happening with Trump, and we don't know eventually where the tariff levels are. Let's leave that aside. Let's park it aside because it's anyway a very small proportion of India's GDP. Let's look at corporate earnings. FY25 was a washout here. I think most estimates, I believe even yours, are around just 5-6% growth for the Nifty. I was going through a Novama note as well, and they're saying that FY26 full-year expectations are at risk. I believe even you've slightly trimmed your estimates for FY26. Where are we on the earnings recovery trajectory?
So, Surbhi, look, FY25 is ending absolutely flattish on EPS terms. While on absolute basis, the earnings are up 5%. In EPS terms, the earnings are up just 1% for Nifty. So we ended FY24 at 1,006 rupees. we are about to end FY25 if this quarter's estimates are met at 1,017 rupees, which is just about a 1% growth. Now, if you look at April 24, when we were first projecting April 25, March 25 numbers, we had projected an EPS of 1142. And all the way down, we are now at 1,017. So there has been about 11 to 12% earnings cut. Similarly, for FY26, right now, we are at 1157 rupees. Now, this number was close to 1,300 rupees a year back. So concurrently for FY26 also, the estimates were cut. I agree that FY26 earnings estimates are also at risk because there are several sectors like IT, commodities, pharmaceuticals, where numbers can change multiple times as we move forward. If you look at the clean earnings excluding commodities, last year Nifty earnings have grown 9%, that is FY25, and we are projecting 12% earnings growth for FY26. One thing that looks quite okay right now is that 26 can be much better than 25. Sure, the base effect can play out there, right? But yeah, there are going to be a lot of intersectoral changes which will unfold depending on first order, second order impact of the global trade war, which is underway right now. So therefore, the natural tendency for any portfolio manager or a strategist would be to try and see, spaces where the damage is limited and focus more and more on domestic plays.
As of now, so just reiterating the number, as of now, your base case is 12% earnings growth for FY26. Potential downside risks could come from sectors like IT, chemicals and pharma, right?
Yeah, even auto for that matter. See, it's very difficult to pinpoint which sector will not see earnings cut. So 12 to 14% is the earnings growth, 12% ex commodities, 14% on a reported basis. That's what our estimates are for FY26. And I would say virtually every sector is vulnerable to earnings downgrade till you see some clarity emerging on the horizon. And therefore, that's why I mentioned the point right at the beginning that the only comforting thing right now is that the valuations are in your favor in large caps.
Okay, all right. Hi, Gautam. Good morning. Good to see you in. Valuations preferable in large cap. That seems to be the consensus as well. But Gautam, I wanted to ask you about the consumption/FMCG index. After a while, when the market's seen a correction, they have actually underperformed. As you have mentioned in your note, normally we see an outperformance coming in from there. Do you think this time around as well, the time has come now where you see the FMCG pack/consumption stocks do relatively better and they could be a place where you could hide?
So, Nigel, top down, that argument can be valid that in periods of extreme volatility, defensive sectors should try and outperform. And that has usually been the case in the past 20 years. The note that you're referring to, we've highlighted various episodes there. And this is the first time that Nifty FMCG index has underperformed Nifty in an episode of a double-digit correction in Nifty. This is happening first time. Second, the age-old argument that consumers should always outperform in falling markets is getting a bit of a reality check because the FMCG companies in India, and more so consumer staples within that, have severely underperformed on growth. If you look at the last 10 years, there are hardly one or two companies in India in consumer staple space where the compounding on top line growth has been 10% plus. So most of the companies have grown their top line in the 5 to 7% band and earnings also in that 7-8% band. They obviously witnessed a huge re-rating between 2010 to 2020 because other sectors were not growing earnings. Post 2020, when other sectors started performing, consumer obviously took a backseat because the growth was not forthcoming. So our view is that within consumption, one has to stay in consumer discretionary and not consumer staples. Because in consumer discretionary, you have visibility of growth. There is a room for penetration and per capita consumption opportunity there. Whereas in consumer staple, now this will be the fourth year where companies will come and give you the same commentary that either urban is slow or rural is slow. So market beyond a point will not accept those excuses till the time they do not see growth. Because the valuations, while they are moderated in the last 2 years, they're still quite expensive for consumer staples.
Yeah. Gautam, you have such a wide coverage universe, you and your team. Give us some specific instances of, sectorally, because, there is an annexure as well, which is being updated continuously because there are a lot of exemptions being provided and it's changing, it's dynamic. So, for example, after this, we are talking to two chemical companies, to understand what is the impact there. But in your coverage universe, maybe do it sectorally. Where is the impact coming from? Direct. I'm talking about direct impact. Products which are sold in the US. Indirect, of course, everything will get hit. Go on.
Yeah, so no direct impact, Prashant, as you would have guessed, can come in auto, chemicals, pharmaceuticals. These are the three most important stock market relevant sectors. Textile obviously is a beneficiary, but textile has a very little market cap and it's not there in a lot of portfolios either. And even if you look at the discussion around textile companies, they're very episodic, right? So from an investable universe point of view, the direct impact I can foresee at the moment is in auto angs, a bit of pharmaceuticals, chemicals. And on the positive side, you might see beneficiaries emerging in EMS spaces, right? Indirect, as you rightly said, it can manifest in multiple sectors as we move forward, because IT obviously is not a direct impact, but an indirect impact as the corporates, sort of start penny pinching in their tech spend. So clearly, you've seen huge impact on IT companies in the last 1.5 months. If you recall, between September to January, IT companies didn't correct at all. In fact, they were the ones which were providing resilience to Nifty. But in the last 45 days, you would have seen IT companies have also taken a big knock, and more so after this whole announcement of tariffs started rolling in. So very few sectors limited, Prashant, where you can say the impact is not there. Obviously, financials will remain insulated, and which is why you would see every guest on your channel talking and belaboring on financials. We've also done that. We've also increased the weight on financials in our model portfolio since last 6-9 months now. We've done that this quarter also when we did the revision.
Gautam, you're making us feel very glum this morning. I mean, there's Mr. Donald Trump, who's anyway making the whole world feel very glum. But, I'm hearing your commentary. It's sobering. It's a reality check. We have to take it as it comes. I mean, you're saying this year was washout. We didn't have any earnings growth, practically none. Next year, best case is 12%. No, I'm just completing. Let me complete my question. What I'm coming to. So 12% best case if we don't get more downgrades. Credit growth estimates are also at 10%. We're talking financials, right? Which brings me to the question that I asked Prashant Jain yesterday. 10% earnings growth, 10%, probably credit offtake. Are we talking about this market becoming a 10% return market then? X of all the tariff headlines, because that's a very new sobering reality for a lot of the post-COVID investors.
But that's not surprising, Surbi, because between 2020 to 2024, you had 20% earnings compounding. The market gave you 20% returns. 25 was a washout year, as you said, in terms of earnings. And if 26 is also a 10-12% kind of year, then market will be quite fair in giving you 10-12% returns. Ultimately, market will respect the corporate earnings. In the short term, it will obviously fluctuate a lot depending on news flows and noise. But over a period of time, if you look at 2-3 years, you will always find that the line of earnings growth usually converge with the line of index returns. So it's not surprising. In fact, what was surprising was when you got 5-6% growth in first of FY25, the market kind of ignored it and kept on rallying for whatever reasons. There was liquidity gush, there was huge positive sentiment and all. So now it's quite fair that Nifty is now trading at a 10-year average. It's reflecting the underlying economic uncertainty and also the corporate earnings.
So you know what? I think next time we have to get Ramdevji back. And I want to see his take, because Ramdevji, he's an eternal bull on the Indian market, right? And I know his math. His math is if earnings are compounding at 15% every year, the market will compound at 15%. And every 5 years, the market should double. But maybe, is that thesis at risk? Because you're talking about very hard reality when it comes to corporate earnings and overall growth.
So 5 years, if you stretch, and if you see 12 to 15% earnings growth, market will still double at 15% compounding. What we are discussing right now is FY26, and even those estimates are at a risk. So the reality is very different today. Hopefully, when we speak in July after the next preview, a lot of these things should have settled, and our confidence in that 12-14% earnings growth would have gone up, because then the market can read it a little bit if the assurance of that 14-15% earnings growth is there for FY26, FY27.
Fantastic. I'm so glad.
Different fronts.
I'm so glad we're ending at least on an optimistic note that thesis of the market doubling every 5 years, that is still intact. We just have to get through maybe a slightly difficult FY26. All right, always a pleasure, Gautam, having you on the shows. Thanks so much for joining in today.
Thanks.